You think you're losing money to bad luck or natural inflation? You're not. You are losing purchasing power to a calculated system, one designed to break under its own weight, absorb public wealth, and quietly reset itself. For over 2,000 years, the playbook has remained remarkably identical. Whenever the state runs out of money, it never stops spending. It never admits bankruptcy. Instead, it changes the fundamental rules of money. Different centuries, different terminology, but the exact same trick. Let's go back to the 3rd century AD. The Roman Empire was collapsing under its own massive size. Military expenses were exploding, corrupt politicians were siphoning state wealth, and barbarian invasions pressed on every border. The Roman treasury faced an absolute catastrophe. It needed to pay hundreds of thousands of soldiers, but it simply didn't have enough silver coins. So, what did Emperor Aurelian and his predecessors do? Did they raise taxes directly? No. Direct taxation causes immediate public revolts and political ruin. Instead, they executed the first systemic financial trick in recorded history. The silver denarius was the backbone of Roman commerce. Rather than minting fewer coins, the Roman mint began melting down pure silver denarii and mixing them with cheap base metals, primarily copper. To the naked eye, the coin looked nearly identical, but its intrinsic silver content plunged from over 90% down to less than 5% over a few decades. The mechanism was simple. The state created more money out of the exact same physical amount of silver to fund its short-term survival. The result? Massive monetary chaos. Merchants immediately realized that the coins were worthless, so they demanded 10 times more coins for the exact same loaf of bread. Prices skyrocketed, trade collapsed, and citizens lost their entire lifetime savings overnight. You might think this is ancient history. It isn't. Today, governments don't melt down physical silver in a furnace. They add digital zeros to central bank balance sheets with a simple keystroke. The physical medium transformed, but the economic mechanism, diluting existing supply to fund state deficits, is completely identical. Jump forward to medieval Europe, specifically the wealthy merchant republics of Venice and Florence during the 13th and 14th centuries. Kings and city-states faced a perpetual dilemma. Wars were becoming brutally expensive, and wealthy merchants were getting smarter at hiding their physical gold. Direct seizure of wealth meant immediate rebellion or the flight of merchant capital to competitor states. So rulers invented a sophisticated new instrument, forced loans. Here is how the mechanism functioned. The state passed laws requiring all citizens of property to surrender a specific percentage of their liquid wealth. In exchange, the government didn't give them their gold back, it gave them paper receipts. These paper promises pledged to pay back the principal later. Notice the brilliant asymmetric transfer of risk. The ruler obtained instant, high-grade capital to fund immediate military ambitions. The working class and merchants were left holding paper promises backed by a government that was frequently on the verge of default. Who paid for it? The working population, through heavy taxes, levied decades later to service those forced receipts. This laid the foundation for modern state finance, consuming tomorrow's wealth to solve today's political crisis. Then came the single biggest structural shift in modern financial history. The year was 1694. King William III of England was broke. His navy had been shattered by the French, and financiers refused to lend him a single gold coin. England was facing total geopolitical defeat simply because it lacked liquid cash. A group of private London merchants approached the king with a deal. They said, "We will gather 1.2 million pounds in gold and lend it to the crown. In return, you will give us a royal charter. This charter established the Bank of England. Furthermore, you will grant us the exclusive monopoly to issue paper banknotes backed by that debt." This was the birth of the modern central banking apparatus and the concept of sovereign debt. Before 1694, when a king borrowed money, he was expected to pay it back. After 1694, debt was no longer a temporary liability. It became a permanent financial asset to be rolled over forever. The government obtained an endless line of credit. The private bankers obtained a perpetual stream of taxpayer-funded interest payments, alongside the power to control the national currency. The state realized a profound truth. You never actually need to pay off your national debt. You only need to service the interest. Every dollar, pound, or euro in circulation today is not backed by gold. It is backed by a government debt obligation. Money is debt. Fast forward to the total wars of the 20th century, World War I and World War II. Industrial warfare demanded capital on a scale never before witnessed in human history. Weaponry, logistics, and millions of soldiers required trillions of dollars. How did governments mobilize this staggering amount of capital without causing immediate civil panic? They rolled out a massive cultural campaign, war bonds. Governments used relentless media campaigns to convince ordinary citizens that buying low-interest war bonds was their moral and patriotic duty. Millions of citizens poured their hard-earned cash into these paper certificates, trusting in the promise of their nation. At the exact same time, behind closed doors, central banks bought astronomical amounts of government bonds directly, printing unprecedented volumes of money. The mechanism was a double-edged sword. First, they absorbed the public's immediate cash through bond sales, suppressing short-term consumer demand. Second, they inflated the total money supply to pay for war production. The currency pool expanded rapidly while individual value stayed hidden. When the wars ended, citizens proudly redeemed their bonds. They received their principal back plus tiny interest payments. But there was a catch. Because of massive monetary expansion, the purchasing power of that money had been slashed in half. Citizens were paid back with nominal numbers, but real purchasing power had been quietly confiscated. It was a massive, legally mandated transfer of wealth. Notice the pattern emerging across centuries. At every stage of history, the trick relies on one fundamental psychological device: perception management. The state cannot simply take your purchasing power by force. It must rebrand the extraction. Inflation is rebranded as necessary economic growth. Confiscatory state debt is rebranded as patriotic duty. Unfunded government spending is rebranded as public investment. Endless currency creation is rebranded as financial stability. Different centuries, different terminology, identical economic mechanics. Now, let's look at our modern era. In 2008, the global financial system reached a catastrophic breaking point. Wall Street investment banks had spent a decade creating toxic, hyper-leveraged financial instruments. When those bets blew up, the system faced insolvency. Instead of following market discipline, governments executed the largest wealth transfer in history. They declared these institutions too big to fail. Who paid for it? Ordinary taxpayers, through direct state guarantees, national debt expansion, and years of fiscal austerity. To keep this fragile system alive, central banks launched a brand new monetary experiment: quantitative easing. How did QE work? Central banks created trillions in digital reserves to buy bonds from private banks. This money did not flow into your paycheck. This liquidity rushed directly into speculative financial assets: real estate, stock markets, and luxury goods. QE was simply ancient currency debasement scaled up for the digital age, socializing private losses while privatizing financial gains. So, why doesn't the public rise up and demand an end to this? Because the modern system utilizes a sophisticated defense mechanism: engineered complexity. The global financial framework is intentionally hidden behind tens of thousands of pages of dense regulations and complex academic jargon. Terms like yield curve control and liquidity facilities are designed to make ordinary citizens tune out, believing finance is too complicated for them. This dynamic creates what economists call regulatory capture. As the old phrase goes, better to own the referee than to fight the game. When financial institutions hire former officials and write the draft language for legislation, the rulebook will inevitably favor the rulemakers. The system isn't broken. It is functioning precisely as it was designed to function for those who hold the pen. When you pull back from the individual events, you see the overarching, perpetual cycle. First, expansion. The state and central banks create cheap money and easy credit to stimulate short-term political growth. Second, speculation. Cheap money inflates asset bubbles, enriching those closest to the monetary spigot. Third, crisis. The bubble inevitably pops when debt burdens become unsustainable. Fourth, bailout and debasement. The state prints new currency, absorbs private losses, and pushes the real cost to the public through inflation. Repeat. The cycle starts again, but with higher baseline debt and lower currency value. Look back across 2,000 years of economic history, from Roman silver coins melted down in ancient furnaces, to digital central bank reserves generated on modern computer servers. The underlying principle has never shifted. When the financial architecture breaks, the bill is always passed down to the productive working class. You cannot individually stop these global macro cycles. They result from state incentives and fiat currency mechanics. But you can stop being a passive victim. Study the patterns, shift capital out of depreciating fiat, and understand asset protection. The final question left for you is very simple. Are you going to continue playing this financial game blind, or learn the rules? If you want to protect your wealth, hit the subscribe button. We break down the hidden mechanics of money every week. See you in the next cycle.